Ever dreamed of quitting your 9 to 5 job and living life on your own terms? Imagine waking up without an alarm clock, knowing that your bank account is growing even as you sip your morning coffee. Sounds like a fantasy? Well, it doesn't have to be. So I want you to take a moment and think about this question. What does being rich mean to you? Is it having $1 million in the bank? Is it owning a mansion or driving a fancy car? Or maybe it's about something deeper, like having the freedom to do what you love without worrying about money. For many, being rich isn't just having lots of money. It's about financial freedom. It's about having enough passive income to cover your living expenses so you can spend your time on what truly matters to you. Whether that's traveling the world, starting a passion project, or simply enjoying more time with your loved ones. Let's hear from you. Drop a comment below and tell me, what would you do if you didn't have to worry about money? To quit your job and achieve financial freedom, you need a plan. And central to that plan are income-generating assets. But what exactly are these assets and why are they so important? Income-generating assets are investments that provide you with regular income. This could be through interest, dividends, rent, or profits from a business. The beauty of these assets is that they work for you, creating a steady stream of income with minimal effort on your part. Let's break this down with some data. According to a 2020 report by the U.S. Federal Reserve, the wealthiest 10% of Americans own 89% of all stocks and mutual funds. These are income-generating assets that grow in value over time and provide a regular income through dividends and capital gains. This is a key factor in how the rich get richer. They let their money work for them. Now, you might be thinking, but I'm not rich. How can I start investing in these assets? The good news is you don't need to be wealthy to start. Even small investments can grow significantly over time thanks to the power of compound interest. For example, let's say you invest $1,000 in an index fund that returns an average of 10% annually. After 20 years, without adding any additional money, your investment would grow to nearly $7,000. And if you added just $100 a month to that initial investment, you'd have over $72,000 after 20 years. That's the power of consistent investing and compounding. Now, here's how it works. When you earn interest on your investments, that interest itself starts earning interest. It's like a snowball effect. The longer you let it grow, the bigger it gets. So by investing in income-generating assets, you're essentially setting up multiple streams of income that can support you, even if you decide to leave your job. This is the foundation of financial freedom. Hey, stay tuned because next up, we're diving into the first type of income-generating asset on our list. That's index funds. And you don't want to miss this. Coming up, we're going to uncover some of the most powerful assets you can invest in today, from high-yield dividend stocks that pay you just for holding them to the lucrative world of rental real estate and the stability of bonds. If you're enjoying the content so far, hey, make sure you smash that like button and subscribe to our channel if you haven't already. What exactly are index funds? Well, in simple terms, an index fund is a type of mutual fund or exchange-traded fund, ETF, that aims to replicate the performance of a specific market index. This could be something like the S&P 500, the Dow Jones Industrial Average, or the NASDAQ 100. These funds are made up of a diverse mix of stocks from different companies, mirroring the composition of the chosen index. The idea is to invest in the broader market rather than picking individual stocks, which reduces risk and offers a more stable return over time. Hey, let's break it down with an example, shall we? If you invest in an S&P 500 index fund, you're essentially buying a tiny piece of all 500 companies in the S&P 500. This means your investment is spread across major corporations like Apple, Microsoft, Amazon, and many others. Let's put this into perspective with some real numbers. Now imagine you invested $10,000 in an S&P 500 index fund 30 years ago. With an average annual return of 10%, that initial investment would have grown to over $174,000 today. That's the magic of long-term investing and compounding returns. Now, you might be wondering, how do index funds generate income? Well, there are two main ways: dividends and capital gains. First, let's talk about dividends. Many companies in an index pay dividends, which are regular payments made to shareholders out of the company's profits. When you invest in an index fund, you receive a share of these dividends, providing you with a steady stream of income. For example, if the S&P 500 index fund you're invested in has an average dividend yield of 2% and you've invested $10,000, you could earn about $200 a year in dividends. This might not seem like a lot initially, but remember you can reinvest these dividends to buy more shares, which increases your potential for future earnings. The second way index funds generate income is through capital gains. This happens when the value of the stocks in the index fund increases over time. When you sell your shares at a higher price than what you paid, you make a profit, which is your capital gain. Number 2 is dividend stocks, and simply put, these are shares of companies that distribute a portion of their earnings to shareholders on a regular basis, usually quarterly. This distribution is called a dividend. Think of it as a reward for investing in the company. One of the most famous dividend-paying stocks is Coca-Cola. Coca-Cola has been paying dividends consistently since 1920. As of 2023, Coca-Cola's dividend yield is around 3%. This means that if you invested $10,000 in Coca-Cola, you could earn approximately $300 a year just from dividends. Here's how dividends are typically calculated. A company declares a dividend per share, say $1. If you own 100 shares, you'll receive $100 in dividends. This payout can be used as income or, better yet, reinvested to buy more shares, compounding your returns over time. Number 3 is land and agriculture. We've covered the ins and outs of index funds and dividend stocks, but now it's time to dive into an income-generating asset that you might not have considered. Yep, land and agriculture. This asset class has been creating wealth for centuries. So how do land and agriculture investments work? Well, at its core, investing in land means purchasing a piece of property with the potential to generate income. This can be through leasing the land for farming, growing, and selling crops, or even land appreciation over time. For example, if you own 100 acres of farmland and lease it for $150 per acre annually, you could earn $15,000 a year. This income is often stable as demand for agricultural products remains consistent. Investing in specialty crops can also be highly lucrative. Take almonds, for example. The average yield for almonds is about 2,500 pounds per acre, and with prices around $2.50 per pound, you could earn $6,250 per acre. On a 10-acre almond farm, that's $62,500 a year. Now, you might be thinking, I don't have the expertise or the time to manage a farm. That's where agricultural REITs, real estate investment trusts, come in. These are companies that own and operate income-producing farmland, allowing you to invest in agriculture without getting your hands dirty. One popular agricultural REIT is Gladstone Land Corporation, which owns farmland and leases it to farmers. Since its inception, Gladstone Land has provided investors with consistent returns through both dividends and land appreciation. As of 2023, they've offered a dividend yield of around 3%, providing regular income to its shareholders. Now let's dive into number 4. The most popular and powerful ways to generate passive income is rental real estate. Essentially, you buy a property and rent it out to tenants. The rent payments you receive provide a steady stream of income, while the property itself can appreciate in value over time, adding to your wealth. Let's start with some numbers to put things into perspective. According to the U.S. Census Bureau, the median monthly rent for a residential property in the United States is about $1,200. Now imagine you own a property that costs $200,000. If you rent it out for $1,200 a month, you're looking at $14,400 in annual rental income. Of course, you need to factor in expenses like property taxes, insurance, maintenance, and property management fees if you're not managing it yourself. Let's say these costs total $400 a month. That leaves you with a net rental income of $800 a month or $9,600 a year. Over 10 years, that's $96,000 in passive income, not including any potential appreciation of the property's value. We've covered some fantastic income-generating assets like index funds, dividend stocks, land and agriculture, and rental real estate. Now, number 5, it's time to dive into an asset class known for its stability and security, bonds. A bond is a loan that you, as an investor, provide to a borrower, typically a government or corporation. In return for your loan, the borrower agrees to pay you regular interest payments called coupon payments and return the principal amount at the end of the bond's term, known as the maturity date. Bonds are generally considered safer than stocks because they provide predictable income and return of principal. However, not all bonds are created equal. Let's break down the main types. Government bonds issued by national governments. Examples include U.S. Treasury bonds, which are backed by the full faith and credit of the U.S. government, making them very low risk. There is also municipal bonds and corporate bonds as types of bonds. Take U.S. Treasury bonds, for example. In 2023, a 10-year Treasury bond offers an interest rate of around 3.5%. If you invest $10,000 in these bonds, you'll receive $350 annually in interest payments, plus, at the end of 10 years, you get your $10,000 back. And there you have it, a glimpse into the world of income-generating assets. If you're ready to bid adieu to the rat race and embrace financial freedom, hit that subscribe button and join us on this exhilarating journey to wealth. Remember, the road to riches is paved with knowledge and action, so explore your options and take the first step towards a life of abundance.